Hey, good morning, everybody. It's Hammer. Today is Wednesday, September 17th, 2025. I, of course, am here with your daily mortgage market update. I think I'm going to start calling this Hammer Live. I think I'm just going to do that. I think it's fun. Anyway, remember, I am the guy out there that helps originators get loans from Google and AI search and social media. We've got an amazing suite of products that'll help you with that. You are welcome to subscribe to one or all of them. So check out Originator Success, Grab and Go Social, and Rate Sensei. So I'll have more about that soon. Anyway, you can join me live each and every weekday morning as I go live 9:30 Eastern time on Facebook and YouTube, talking about what's going on with the lovely world of mortgage rates and pricing. Today we're going to be talking about the fact that it's Fed Day and what is likely to happen to rates. We're going to talk about why rate sheets are actually better than they should be. And I say should in quotes, and I'm going to show you what I mean by that. So rate sheets are actually better than they should be. And we're also going to talk about how to protect your pipeline today. So that's the stuff we will be going over today. It's so great to hear from all of you this morning. Let me know that you're here. I'm going to go ahead and let's see. Let's say hi to the live folks. There you are. Remember, if you would like a reminder that I'm going live each day, you can sign up for a quick text alert. Just a quick text that gives you the link and reminds you that I'm live so that you don't miss anything. Sign up at hmmr.io/reminder or use this cool QR code. If you're on your phone right now, don't worry. Take a screenshot. You can go back to your photos and that QR code will still work. We don't sell your information. We're not going to use it for TikTok. We just send you a text message that I'm going live so you don't miss any of the wonderful action. That's what we got going on. So definitely go ahead and check that out. Let's go ahead and say hi to all the live folks here, all of my friends this morning. Let's see who is here and say hello. First one to say hello was Michael Love over there on the YouTubes. Good morning, Michael Love. Happy Fed Day. Robert Bashir. Good to see you, sir. Amy Blauser, Mike Brown, Jerry Avila. Great to have all of you here. Amber Moser, Monica Dinkins. So many wonderful, familiar faces. Mallory Fotiadis, Megan Bissell, Yasmin, Martin, Holly Johnson, Nicole Semerad. Ron Siegel, good morning, sir. He said, today we're celebrating National Monte Cristo Day, but he knows we're not. We're celebrating National Fed Day. Today's going to be a good day. This is really, I think, going to be a good day for rates, and I'll tell you why. We're not going to see rates like drop crazy, but we are going to see rates go down, and that's what we want to see. So good morning, Bobby Searson, Amanda, Colin, Deb Dickinson. Good morning, all right. So let's get into this a little bit. So first of all, let me jump to the middle. Before we actually talk about what's going on today, I want to talk to you about why rate sheets are better than they should be. And that will actually go into what we're talking about today as well. Let me just open up Presentify real quick. There we go. Okay. So let me share my screen and I'll show y'all what I'm talking about and what I noticed. So using Mortgage News Daily as a reference point, again, it's not the end all do all, but it's consistent, right? And using Mortgage News Daily as a reference point here, if we take a look, it shows rate sheets at around 6 1/8, which 6.13, by the way, this is almost as low as we hit back here in September of last year. That low there was 6.11, according, like again, using their thing. So we got 6.11 there, 6.11. This shows us at 6.13. And look at the jump. We were so much 6.29, 6.29, 6.28, 6.29, 6.27, 6.29. We improved a little bit from on Monday, right? And that made sense if we go back and take a look at mortgage-backed securities, because on Friday we were down here and on Monday we were up here. So on Friday 101.12, on Monday 101.29. That is plus 17 bips, right? So that's plus 17 bips. Now, if we go ahead and we take a look here, on Monday we were at 101.29. Tuesday we were at 101.27. We lost 2 basis points. Yet take a look at rate sheets, and according to Mortgage News Daily, rate sheets got better and not worse, which is what should have happened. So rate sheets are not, and what this tells me when I look at this, remember, this is an average on all different rate sheets. What I'm seeing here is it shows me that lenders are probably shrinking margins in order to increase volume. We know that the magic number is 5.99, right? Anything with a 5 in it is going to spur activity. So it looks to me like lenders are starting to stretch a little bit to get into there. So keep that in mind. Let me go ahead and show y'all some other things real quick, popping this on here. So if we go ahead, let's do a quick recap of what happened yesterday. You could see, looking here, bonds ended the day. They were down just a little bit lower. It was a couple basis points. It's actually red. So, I mean, it's a negative day. It's a cry day, but it was only 2 basis points. So it really wasn't that big of a deal, but they were down on the day here. And if we take a look at like the end of day text message that we had here, let me pull this up and, show you the end of day text message. There it is. Okay. All right. So taking a look here, actually, let's go with purple. There you go. So bonds doing exactly what was expected. No real moves because we were up 4 basis points and then we were down 2. I mean, it's only minus 6 bips on the day. It's really nothing to get worried about. We'll likely see bonds improve through the AM ahead of the Fed meeting in dot plot, and that is what we're seeing this morning, up about 3 basis points at the moment. The real moves come around 3 to 3:15 during Powell's press conference. Little risk to floating into tomorrow. See how the dust settles. See you then. So if you would like to find out more about getting these text alerts, you can go ahead and sign up at ratetextalerts.com. Definitely, today is the day to sign up for those if you're not signed up. I'll be sending out an alert, right around 2 p.m. as we get the initial market reaction to the Fed. Then we'll send out something around 3:15 when we get the market reaction to the press conference. And then we'll be doing an end of day wrap up. So it's going to be a busy day today. Make sure you're signed up for the text alerts. But otherwise, as we go through this other stuff going on today, the quick recap of what was happening there. No, I don't want to do it today. We're talking about, I want you to see my ad. There you go. Rate sheets are improving quite a bit for lenders. They seem to be stretching now. I wanted to show y'all, if we go to, where is August 26th and 28th? So you see it right here. Okay. So August 26th, 100.46. August 28th, 100.59. So that's 13 basis points, right? 13, 15 basis points right here. When we see right here, this movement here. And that's really, I mean, it's basically the same thing that we saw here, but yet when you look at the effect that had on rate sheets on the 26th to the 28th, there was like no difference, right? It was just a very minimal. Oh, you can't see that. Hold on a minute. Come on, Hammer. Get your stuff together. Okay. So the 26th to the 28th, very little difference. I mean, well, actually, that's 26 in the. So 6.52 worked its way to 6.5. That's normally what I would expect to see on a rate sheet when you see 12 or 15 or even 17 basis points. However, look at the way we've gone from 6.29 to 6.13. And again, this is an average, which tells me that there's lenders that are pushing into that magic 5 number. And then there's some other ones that are pricing more along the lines of where it should be, right around here. And that's why we're coming up with the middle. That's why you see that move there. So this has not been confirmed to me. Curious if you guys are seeing that as well. Let me know in the comments. Do you guys see that kind of behavior? Do you see lenders that are kind of giving up a little margin right now, pushing, and they'll make it up on volume? is what I'm seeing here. So let me know if you see that same behavior, because that's what I think is happening and what I kind of see here. So let me know if you guys are seeing that. Let me move this to the side. We'll go over everything else today and what we're going to be covering. So let's talk about the actual Fed meeting today and where that's going to leave us and what's going to happen. So first of all, markets have been pricing in the idea that we're going to see a September Fed rate cut. It's been pricing that in for weeks now. If we take a look here, I mean, a month ago, it was pricing it in. A week ago, it was pricing it in. Yesterday, it was pricing it in. Markets have already priced in this rate cut. Now, don't go out of your way. Let me get rid of that. Don't go out of your way trying to explain to people that this has been priced in, because what's going to happen is, what is it that I'm trying to say is causality. It's not caused. Rates are likely to improve today. I think we're going to see mortgage rates improve today. Happening, coincidence is not causality. It's going to happen at the same time that the Fed is going to cut rates. So people are going to say the Fed cut rates, mortgage rates went down. Don't go out of your way trying to teach everybody and educate them on it. Just go with it. Write loans. The reason we're likely to see rates go down. So first of all, we got the dot plot happening today. The dot plot is the individual anonymous Fed members putting out there what they think rates are going to be, the Fed funds rate at the end of each year. So we got 25, 26, 27, and beyond. Well, guess what? When they do this dot plot, we're only going to have 2 more meetings this year. So right now, markets are pricing in an average of 2 rate cuts. That's what the blue is, the average, like the median, the most number, right? And there were a bunch that priced in no rate cuts up here. This was the last dot plot that we got. Well, that's obviously, this is all going to change quite a bit, significantly. Number one, I think that you're going to see this line right here above 3.5. This is the one that's going to start to see. Oh, actually, you know what? We should use the pretty blue like theirs, right? There you go. So I think you're going to see this. And markets are going to expect that we're going to see 3 cuts. That means that we're going to get a cut at the next 2 meetings. We can check those boxes, right? We're going to get a cut for the next 2 meetings. Then it's what's going to happen in 2026. Now, there's a couple of things that are going on here. So you've got Moran, who's going to get in there and vote this time around. We've also got Bowman. So we know Mickey, right? We know Mickey Bowman. I know this, you can't read it, but I don't care. We've got Waller, right? Chris Waller. And now we're going to have Moran. So we may actually get some dissent today where these ones say, hey, we need to see a 0.5 point cut. And we're not going to get a 0.5 point cut today. It's going to be a 1/4 point cut. But they may dissent and say we should be going big and doing this. And I think basically the whole emphasis on this here. Now, there's a lot of articles about the independence of the Fed and how much Trump is going to be able to influence that, right? So Fed cut to mark pivot towards the job market. This is the key. So you're going to get a lot of talk about this in Powell's press conference. So first of all, let me kind of make sure I'm summarizing this, getting all my thoughts out properly. 2:30 p.m. Eastern time, the Fed's going to come out with their policy statement. It's going to show a rate cut. It's going to be a 1/4 point. Markets are going to react very positively to the dot plot, which is going to show 3 cuts this year. And depending on what they show in 2026, it's not going to be a huge improvement, but we're going to see rates rally. We're going to see bonds rally. So right now we're up a whopping 5 basis points. This will probably, after the Fed meeting, my call, I say this goes up by another 10 to 15 bips. So we're going to be pricing at 0.1, at 15 basis points or 20 basis points after, at around 240, 245. I think that's where you're going to see. You're going to see that kind of a reaction to this. You know what, Ron? I totally disagree. She's much smarter than me. Danielle DiMartino Booth noted potential of negative reaction to a 25 basis point cut as too little too late. She could be right, and to the fact that it is too little too late, but markets are not going to react that way. Again, I think that the woman is amazingly intelligent, much smarter than me, but this is clear. Markets believe there's going to be a quarter point cut. If we had a much bigger expectation of a half point cut and only got a quarter point cut, that would be the only way we would see negative reaction. And also, she's going to be looking at, when she says markets, she's going to be looking at stocks. I'm looking at bonds. Bonds are not going to react negatively. So what I'm also looking to have happen right now, we got the 10-year treasury at 4.03, 4.02. That's going to drop into the threes. The question is, do we stay in the 3.9s or does it break into the 3.8s? And I think I think we have the potential to see the 10-year treasury yield drop 15, 18 basis points, work its way into those 3.8s. I really do. It would be, 17 to 18 basis points to drop that far. But I do think at a minimum we'll be in the 3.9s for sure. I think that we will no longer be at a 4 for the 10-year yield. So, and that's there. So we know what's going on here. Now, again, for y'all, lean into the Fed rate cut. Lean into lower mortgage rates. This is what people are reading right now, right? This is what's going to be all over the media. Mortgage rates fall to, lowest levels you're going to hear in years, right? Because when we use Mortgage News Daily as a reference point and we take a look here, let's go back. The last time that we saw, we're going back into 2022. The last time that we saw rates in a 5 handle, look at this, right? There was nothing until 2022. So you're going to hear the best rates in 3 years. That's what you're going to start seeing on headlines here. You're going to see the best rates in 3 years. And you want to be proactive. Now, remember, you're also going to be fighting your servicers. Servicers are fighting hard to retain their servicing portfolios. They don't want to lose these loans to refis. You have to be out there. Now, Originator Success members, we're going to be helping you to stay in front of those past clients. We're going to send out some stuff, even though it's unscheduled. And some of our members may be like, why did you send that? But when they get loans, everyone's going to be happy. One of the things we do at Originator Success, our members put in their lists into our system, and we're like a quasi CRM. So we help to shake those trees and get business. This is the time to do that. So I'm going to put together an email or two about what's going on here, and I'm going to get that out today and help our members get some loans. And I'll be sending that out and telling everybody, but I think today we're going to have today and tomorrow, I think we're going to have a real opportunity for that. So you need to be in front of everybody. You need to be making sure that you're taking advantage of all of this press. Lean into it. We don't have to tell them that they're wrong on why it happened. Just lean into it and write the deals. Now, Jack, we've talked about that before, but let me hit you up with that again. Jack Straw said, let me scroll down here. Jack Straw said, trying to remember why rates started increasing after the 2024 rate cuts. And this is a different situation, and we're not going to see the same thing happen this time. So let me go ahead and push this back here so we can kind of see it a little clearer, right? Right there. Okay. So why we were down here, the Fed cuts rates by a half point, rates skyrocket. Why did that happen? Remember, number one was as we were leading into this, there was talk of recession. I don't want to get super deep into politics about this, but the politics were that we were going into a recession, and people expected Biden to continue to win. They did not think that Trump had a chance at winning. Markets weren't pricing it in. Then after that Fed rate cut, what happened is there was Biden pulled out of the race. That was sometime around there, right? And you had Kamala Harris. Markets started pricing in the idea that Trump was going to win. There was going to be stimulation to the economy. They knew that he wanted to come in and, swinging, and basically the expectation was we were going to see stronger jobs, stronger inflation, and then rates went up. So that was what happened back here. That's not happening this time. There is no talk of recession that's going to disappear. That talk of recession disappeared, and that's why we saw everything get there. So we don't have, what you're going to see right now is continue. If we see a concern over continued idea that we could start to see a talk of recession, you will actually see rates move even lower. The lowest we're probably going to see rates go is in the 5.25 range. 5.75 range. I don't even think we'll get to the mid fives. I don't think that's possible unless we would need to see probably another few months from now to see that happen. But Les Parker's been calling for 3.8, 3.9 by the end of September. 3.8, 3.9 for what, Ron? For the Fed funds rate? Or for mortgage rates? And who is Les Parker? I don't even know who Les Parker is. What is he calling for 3.8, 3.9? But anyway, yeah. So today we're likely to see rates, improve. We're going to get our first bump at 230, 240. We'll see mortgage-backed securities react. And I think we'll see the 10-year, we'll see this drop into the threes after the Fed meeting, and we'll see mortgage-backed securities react positively. We'll see that down here. Let me pull this up a little bit. And let me get rid of that. Here you go. There you are. So, and Ron, I'm excited to have you back as a member, by the way. So, for sure, for shizzle. So, here we go. I think we're going to see this bounce up. We're going to see a nice improvement. I think we're going to see a nice jump up here. And then after the meeting, I think it'll come even higher after the press conference. Not this high. But, realistically, 101.28 should probably go. Actually, no, it would go that high because these are much smaller because there's not much movement. So we will likely see, we'll definitely see it go up here. I think today we're going to see, right now we're at 101.30. I think we're going to end the day around 101.60. That's my premonition. What do y'all think? Let me know in the comments. I think mortgage-backed securities are going to gain at least 30 basis points. And I see that they will be 101.60 or higher. That's what I think is going to happen today. 101.60 or higher. On rate sheets, I think we could see an 1/8 to 1/4 point in rates. It could be that big. Depends on how markets react to Powell's press conference. And we'll see that at around 3:15. We'll see the reaction. The press conference starts at 2:30. He'll do his prepared statements. They're going to pepper him with comments. They're going to talk about, the Fed independence. They're going to push him for Moran. He's going to have to tap dance through a minefield today of all these dumb questions. But depending on, they're going to ask him about inflation, the fact that inflation is moving higher, and he's going to say a lot of the same things, but they're going to ask him about two really weak job readings. Now, I had mentioned about Nikki Timiraos, the Fed whisperer. Let's get into some of that stuff real quick here. So Timiraos wrote an article last night, 9 p.m. Eastern time. Fed divisions thrust Powell into uncharted territory. So what is Nikki telling us? Analysts are watching whether Trump-appointed Fed governors will back a larger rate cut or instead negotiate for stronger interest rate clues. This week, the Fed Reserve's meeting shape up one of the strangest in years. The Fed expected rate cut Wednesday may be straightforward, which, again, we know that it is. It's going to be a 1/4 point, right? But Fed Chair Jerome Powell must navigate contentious disagreements over future policy. That's what's really affecting mortgage rates today, amid a spectacle over who will succeed him when his term ends in May. All of this is coming into play because the idea is markets are trying to figure out what is the 2026 Fed going to look like and how low will rates go in 2026. And if they think rates are going to be much lower, they're going to get in on that now. So again, people are going to think the Fed cut rates today, mortgage rates went down. My mortgage person has no idea what they're talking about when they tell me that that's already been priced in. What markets are going to actually be pricing in is 2026. That's what they're looking at, is 2026. Markets already expect that we're going to see another cut in October. I mean, look at this. And then another cut in December. So I think what'll happen is I think this is going to push up. I think this October one is going to push up. I think, basically this will be gone. I think basically this will be gone. and markets are going to anticipate those extra cuts. Then it's where are we going to be in 2026? Where are we going to be in 2026? And remember, I showed you this was here before, it had been over here, and before that had been over here. Remember, we did that a couple of days ago where we did the compare feature, and you could see, this is what we're at now. This is where we were at. Here it is right here where we were at before, and markets believe that we will be lower in 2026. And I think you'll see more tightening up of that little arc happening in 2026. That's what's going to move markets there. Let's see what else he said, though. No. Here he is. So senior advisor to Trump, Wizard, resigning his White House position. Stephen Moran sworn into the vacancy, so he'll be voting there, and he'll see the potential for Powell to face dissent on the anticipated quarter-point cut from both sides. Trump appointed officials like Moran who want it to go bigger, right? And from regional Fed presidents who are uneasy about stimulating the economy when inflation is stalled out well above the Fed's target. I'm curious now, by the way, we get the PCE inflation data on Friday this week. We have not even bothered. I was going to show you on the thing here. We've not even bothered to talk about it because it's going to come immediately after the Fed meeting. And I don't think it's going to have any effect on rates at all. It hasn't had a lot of effect over the last couple of months anyway. The CPI has a lot more than the PCE because it comes out sooner and it's kind of the lead in, but I don't think this one's going to have much effect at all. So everything is today. Make sure you remember, sign up for our text alerts so that you know what's going on. All right, Ron. Ron's going to send me a copy of the Les's newsletter so I can read it. Thanks, dude. I'll see who he is. Those of us with no life will be watching the Q&A today. I definitely resemble that remark. I will be watching the Q&A for sure. You know what? It's funny though. I watch it with via Meet Kevin on YouTube, and I find it to be funny that way. I like his comments on that. Mark, Frederick, David, great insight as always. Thank you, sir. Appreciate you. Appreciate you. And what did you think about the 10-year? When do you lock in an Earl? I wouldn't lock in an Earl until let's see where things go Thursday, Friday. Unless we get some kind of absolute meltdown today that were to things went in the wrong direction, because anything's possible. I would not be locking in an Earl. So are you a consumer, Donnie One, or are you a mortgage person? I have a feeling you're a consumer. Let me know. I'm curious. Anyone else have any questions before we wrap it up? Anyone else have any questions or anything to say? Thanks so many of you for joining me today. Appreciate you. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time. Tomorrow, we're going to get together and we're going to talk about what's going on with rate sheets and see if any of my predictions were correct. Again, I think we're going to see today around 101.60. I'll have to see if I can remember that. Yeah, you're a consumer. Well, welcome. How did you find out about me, by the way? Just curious. This is generally for mortgage originators. That's why I speak jargon. But I'm glad to answer any questions that you have and that maybe you noticed me because of the VetaVA site. My content is in there. So I think the 10-year will be in threes. So tomorrow we'll get to compare notes and see about that. So Jerry Avila, good to have you, man. Thank you for posting it. Thank you for sharing it. So, all right, I'll catch y'all later. Have a fantastic day. I'll see you guys tomorrow and we'll see how this turned out. Bye-bye.